Now, in the previous lesson, we saw some misconceptions, cleared them, and also learned that over long periods of time, stocks create wealth. There's no refuting that. Let's talk about companies now. So, when a company needs to start, they always start small, humble beginnings. But it needs capital. It needs capital to grow, needs capital to hire and expand business. Now, there are various stages of these capital. So, initially, maybe friends, family get that money on. After that, you have something called angel investors. So, these are private individuals or individuals who are very wealthy, willing to invest in companies showing a lot of promise. Then we have venture capitalists, private equity, and finally IPO, that is listing on the stock exchange. Now, what's interesting is that the average citizen of India, like you or your friend or I, cannot usually invest in these companies during these stages. Because the company is private, it requires some skill for due diligence, and well, they're just not usually done. But when these companies go public, that is, when they list on the stock exchange, you can actually invest in them through the stock market. And that's why that's so beautiful. But I wanted to talk about one more thing. Back to the basics. What is a stock? Basically, a stock is issued by companies to the public. The public, therefore, buys these companies. The companies raises this cash, and this money is invested to grow the business. It's as simple as that. To understand what a stock is, we're going to see the life of a company from startup all the way to big business and the decision to go public. With him, Raj. Raj is your ambitious entrepreneur who wants to take his skills of making the best sweets in Bombay into a business. He wants to sell gulab jamuns, jalebis, rasmalais, you name it, and take it to the public. Like any true entrepreneur, he wants to start a sweets stand, and he calls this Raj's Sweets. You and I are going to guide him on how to make his business a success. All right, so first we need to get the basic paperwork out of the way. He calls his company Raj's Sweets Private Limited and incorporates it. Now he can begin his business, but before actually setting up shop, he needs capital. For that, he has his company, which is 150 shares in total. What he does is he finds an investor, a wealthy individual, willing to invest and who believes in Raj's vision to grow this company. He sells 50 shares for 1,000 each to this angel investor. Angel investor are wealthy individuals who are looking to invest in small startups who have a lot of promise. So he now has 50,000 rupees coming into the company as funding. Now what's interesting is that despite selling these 50 shares, Raj is still in control. He still is majority stake and he still owns 100 shares. Great. At this point, the company is worth 1.5 lakh rupees. But then Raj comes to a realization. He still doesn't have enough money left. So, exhausting all of his investing options, he now goes to a bank who gets him a loan for 1 lakh rupees for the company. The bank lends this 1 lakh to Raj at 10% interest annually. Raj gets the loan and he's ready to start business. We have two investments coming into Raj now. On one hand, you have the banker who's lent 1 lakh rupees to Raj's investment. He's lent 1 lakh at 10% annual interest, meaning he earns 10,000 rupees. Whether the company does well or not, he gets that fixed return. Banks are risk averse, but they still want to make a return. So they're happy with that. Fantastic. On the other hand, you have the angel investor. And the angel investor owns 1/3 of the company, that's 50 shares, and has invested 50,000 rupees into Raj's Sweets. And basically has taken more risk than the banker, but he also is open to much more profits. You see, if Raj's grows all the way from one stall to thousands of stalls over the next 5 or 6 years, he can pocket a huge difference. If Raj company is say worth 600 crores by the time it has pan-India presence, the angel investor owns 1/3 of that 600 crores. That's 200 crores, my friend. On the other side, the banker still gets only 10,000 rupees. That's the fundamental difference between them. The angel investor believes in Raj's business, the management, the future of how this exponential growth can go up, and he can ride that wave upwards. In Raj's case, we have only one investor. That's the angel investor. There can be multiple investors. Look at this of Infosys. This pie chart shows different shareholding patterns. And this can be different in all different companies. All owners own this share, and each share has its share price. But let's get back to Raj. He was starting his company, right? So Raj now has some cash. He can finally begin running and starting his venture. For that, he first needs to set up a basic sweet stall. He needs to get inventory and finally hire one employee to help him out to make those sweets. He begins making those sweets. But let's forward right ahead in time. Let's forward one complete year. Raj's Sweets has done fairly well. The word spread, and by the end of the year, his net income after expenses and taxes is rupees 38,000. Now that honestly doesn't sound like a lot of money. So he needs to make a decision. Should he continue growing Raj's Sweets or not? Because 38,000 rupees doesn't sound like a lot considering he spent the entire year working full time. But let's not get ahead of ourselves. Let's calculate what the company can be 4 years from now. Let's make a few growth assumptions. The first growth assumption is that Raj reinvests his profit every year. Now, it would be nice to buy a new house or a nice car, but he decides against it. He is determined to make this company grow. Number two, he also decides that this money that he reinvests will be used to add new stalls every single year. So at the end of 5 years, he will have multiple stalls in the same area or in different cities. Number three, he also decides that as the years go by, he can charge more per sweet as the word spreads of his good sweets. And it's also safe to assume that at this point he'll be able to sell more sweets as the branding takes place. And finally, the last assumption is that inventory costs and employee costs remain stagnant. Now, what's interesting is, what does the company do 5 years into the future? Raj has done extremely well, and the net income after all taxes has now grown to 10 lakh rupees. The company is now worth 7 times more than what it used to be. The per share value has gone up from 1,000 rupees to 7,000. Now we're going to introduce a concept that you've probably heard of: value investing. So, how valuable is Raj's company right now? It started off with 1.5 lakh rupees as the value of the company, and each share was valued at 1,000. Today, the price of the share has gone up to 7,000 according to the balance sheet. And you can see that every year it was growing. This is definitely a growth company. Now, stalwart investor Warren Buffett uses something called value investing, and he asks a few questions. I think before understanding a method, you need to understand what perspective that investor is talking about. Where is he coming from? What is his objective? So let's try to get into the mind of a value investor. And instead of looking at a balance sheet, let's ask questions. What kind of questions does a value investor ask before he decides to invest in a company? One, what is the competition like? If Raj is doing so well, he could have competition right next door and begin a price war. If that happens, how will Raj's company behave in that point? Will sales go down? Will he be able to retain his customers? Ask yourself that question. Two, is this a growth company? Is it growing every single year? By this balance sheet, you can tell that yes, Raj's company is growing every single year. Fantastic. Next, What is unique about Raj's Sweets? Now, companies like Coca-Cola, for example, have such a strong brand that any new cola company coming in, mighty difficult to displace Coca-Cola. Does Raj have something unique? Also, are there any barriers to entry? Is it very easy to open a sweet shop? Companies like telecom companies, Idea or Bharti Airtel, have a barrier to entry called licenses. You can't just start a telecom company. You need a license from the government, which is extremely difficult to get. What is the barrier to entry for making sweets? Next, and this is overlooked a lot, and it's called debt. How much debt does a company have? This means how much does the company owe money to someone else? Sometimes during good periods when the economy is growing and a lot of business is coming in, companies tend to take a lot of loans. And what happens is that you need to repay these loans. These not free. Every time you repay the loan, it is an expenditure from the balance sheet. Now the question is, in times of prosperity, this is fine, but when the economy contracts, will the business be able to pay back those loans? This can cause havoc in even the best companies. Is the company in a lot of debt? Ask yourself that. Raj certainly isn't at this point. And last, discount. Now, this is peculiar to the stock market. We know that Raj's company is valued at 7,000 rupees per share. So far, so good. But the stock market, because of sentiments or herd mentality, sometimes stocks can trade below book value. These are called value buys. What would you do in such a situation? Ask these questions and you'll understand what goes in the mindset of a value investor. I'll say it again. Raj's Sweets has grown and grown exponentially. In these 5 years, we've grown from 1,000 rupees per share from day one to over 7,000 rupees a share. That's a seven-fold increase. Now, who do you think got the better deal? Our lender friend from the bank, who's still earning a mere 10% a year on that 1 lakh. 10,000 a year. Nice, fixed return, but compare it to the equity investor. His investment has now grown sevenfold or 7 times of his initial investment, right from 50,000 rupees to 3.5 lakhs. Amazing. So why is the equity investor allowed to earn more than the lender? At the end of the day, it comes down to risk and reward. You see, if Raj's Sweets went bankrupt today, then the lender would have first claim over the liquidation. And the equity investor, on the other hand, took a higher risk. And in return, if the business does well, he can reap proportional returns. Makes sense, right? So as we can see, Raj's company has grown from almost nothing to a high valued growth company. It's grown pretty well and will continue to grow. But Raj, he's extremely ambitious. He's thinking big. In fact, he's thinking massive. He doesn't want a few stores here and there. Now, he wants a pan-India presence. Imagine 1,000 of his sweet stalls all across the country. But there's one problem. How does he raise capital to actually execute this plan? He has people, he knows inventory, he knows how to scale the business, but one thing's missing. That's the money, and lots of it. He has a few options. First, he can sell to an outright competitor. He has competitors which are much bigger than he has and been around for decades. He could sell to them outright. But Raj loves his company. He also thinks it can be valued at much higher levels as the years go by. So selling is not an option. Number two, he has the option of selling a part of his company to another investor. Now, that makes sense. He has 100 shares. He could sell 20 to an outside investor and get him on board. But the third option is probably the biggest. And it also gives him a lot of other opportunities. That is listing on the stock exchange. By doing this, 100 shares that he owns, he can actually give a small portion of it, say 20 shares, and release it out into the public, people from all over India, even the world, can invest in Raj's company, and probably he could get much higher valuations. So that's it. That's how a small company from a startup grows and then decides or has the option to go public. In the next lesson, we're going to learn about the role of a stock exchange. How do they function and what are they? Also, what are the Sensex and Nifty exactly? We'll answer all of that and more. I'll see you in the next lesson.